This is our winter roundup of recent tax events. Um, we're going to probably run till about 9:30. We'll see how far we can get. These are the items that I have on the agenda here. And again, we'll work through as many of these as we can in that time period. And if we don't finish up, I think everybody's received a copy of the PowerPoint so they can take a look at any of the remaining material there. And if not, should be available on our website. Possibly the audio of this presentation will be available there too. I think more often than not it is. But these are the main topics. And I put what I thought are some of the more important ones towards the top there, particularly Secure Act 2, which just came out in December. So spend some time on that one. Then the big part of that was the Secure Act 2.0. And historically speaking, it's called Secure Act 2.0 because Secure Act 1.0 was part of the legislation from 2019. And the Secure Act 2.0 originated as three separate bills, which you can see here. And the act has had pretty strong bipartisan support. So really the big issue with it passing was having something to attach it to. And that turned out to be the Consolidated Appropriations Act. So it wasn't terribly controversial. But it is a huge hodgepodge of many, many different little bits and pieces. And we're going to cover some of those, so you'll sort of get a sense of the ad hoc nature of what's going on here. Really, what this thing was all about were these tax credits. So you can see on this slide all these different categories. So these aren't credits; these are just categories of credits. And there can be, 2, 3, 4 credits underneath each of these categories. So there's really just tons and tons of these. And you pretty much get the impression that everybody having anything to do with energy was looking for some kind of an incentive to better be able to manufacture, develop, or sell the products and things. And they get that rolled into this act, and you end up with just tons of these things. I'll go through an example on one. You'll see how complicated it can actually be. Well, let's take a look at a couple of cases involving individuals here. So in this case, prior to being married in 2015, the taxpayers separately enrolled in health insurance through the marketplace. They each elected to receive the advance premium tax credit. Payments were applied by the insurance companies to the cost of their premiums. When they filed a joint return in 2015, they attached Form 8692. They claimed the credit of $4,515 and erroneously claimed that only $3,200 had been paid on their behalf, when in fact it was $7,950. They elected an alternate calculation, but really didn't complete that part of the form. So the IRS issued a refund, but later issued a notice of deficiency for the full amount. Taxpayers claim that the IRS didn't account for the election to use the alternate calculation. The IRS then reduced the deficiency, but in court, taxpayers argued that the IRS was precluded from issuing a deficiency after providing a refund.